David Solomon speaking to investors, analysts, saying that he expects more volatility ahead. He also said it is important to recognize that few countries have benefited more from the post-World War II economic and financial order than the United States. Now, all of that is in question as things change, and it's time now for the Wall Street beat. That brings us to Henry McVey. He is KKR's head of global macro and asset allocation, CIO of the firm's balance sheet. And when you think about this unwinding of the post-World War II order, how do you think about the changes to expect for investors, for companies that are trying to navigate this tariff regime?
Well, first, thanks for having me. Pretty interesting times. Look, my base view would be that actually after COVID, the global supply chain started to change. And what we use this term internally at KKR, let's build supply chain resiliency. So things that were just in China or just in Mexico, we typically have 4 or 5 areas where you can get production right now. So I think there's probably more resiliency than you might think. I think what's really weighing on people, though, is the lunging left and right on what the strategy is. I think most CEOs around the world can operate if they know kind of the rules of engagement. You've seen the bond market. Obviously, you guys have covered this well. You've seen that highlight. I mean, to me, what's President Trump trying to achieve? He's trying to achieve lower taxes, deregulation, more power to the states, and then he really wants to address national security around key things such as semiconductors, as well as pharmaceuticals. That all makes sense. But you've got to think about how you're going to make kind of communicate that message, because right now we have a 4% current account deficit, we have a 7% fiscal deficit, and foreigners own about 33% of our treasuries and 18% of our stocks. So when you make sudden moves one way or the other, that upsets the apple carts. A lot of the trade rhetoric has really been around the trade deficit. It hasn't been as much until recently around the liabilities. Our analysis at KKR, if you go through it, there are really 4 or 5 countries headed with China at the top that actually have the concentration of the deficit. And then when you look at goods, when you look at the trade deficit by areas, really 3 areas: autos, capital goods, think washing machines, and then what you saw over the weekend, electronics. That's 80% of the deficit. So as we go through this together, and hopefully we'll keep talking about it, those are the areas to focus on. So what we saw on Friday was really around iPhones and computers. That's $50 billion from China, both on iPhones as well as computers, and you probably need some relief there. So I think we've seen 2 Achilles heels on the administration's game plan, even if the long-term objective is good. One is the bond market, and second is on day-to-day household goods. We can't have a stop of production of iPhones. We need to figure out where we want to be. So our base view is we end up with kind of 10% tariffs across the board in many areas, and then we see negotiation and the reciprocal, and that's probably will be more fluid. And you were all referring to the VIX. The VIX is capturing that fluidity of those other reciprocal tariffs.
It looks like President Trump wants to get rid of the trade deficit. And what we have now is a situation where, they make stuff for us cheap, we pay them for it, and then they use that money to buy treasuries and U.S. equities, essentially financing this whole thing. What we want is if I understand correctly, we make stuff, we sell it to them, but they still buy our treasuries and U.S. equity. Do they still finance the whole thing?
I think when you let's take a step back. There has been, since China joined the WTO, Matt, that is exactly what's happened. Today, you would say the U.S. is 4% of the world's population, 25% of its GDP, and 65% of the market cap. So it'd be hard to argue that strategy is not working. You can argue about 2 things, though. One has been the distribution of that wealth, which I think the president has talked about, and second is around national security. Those are the base minimums that I think this administration wants to achieve. We don't know yet, to your point, what the right balance is. I don't think it's that we're going to own all their foreign assets and we'll be selling to them. That just doesn't work in a world where you have comparative advantage globally. So I think we're figuring out that balance. What you're highlighting, though, and the reason we've had so much volatility, is that most global investors, when you think about big sovereign wealth funds, they've been overweight the U.S. since COVID, because we were the country that was stimulating the most. We had the best market performance, and we were ahead on AI. But they also have international liabilities, whether it's Canada, China, Europe. And when you go into a world where equities go down, bond prices go up, and the dollar weakens, that sets off risk problems for firms. They're set up in a world, if you think about asset allocation theory, stocks and bonds are supposed to diversify each other.
Right.
Everything that you guys have been reporting about is the exact opposite, right? The dollar's gone down, equities have gone down, and bonds go up. That is a very unsettled market for big global allocators that are trying to create retirement savings. And so that's something that I think in this new world order, I don't think it's going to get fixed overnight. I mean, I think this is going to be a really busy time, not just this week or next week, but probably the next 6 or 12 months. The offset of that is that, again, I would say what we saw since COVID is supply chains are better set up to do this. And second is, when we see this in our 175 portfolio companies, we come into this supply shock with pretty good momentum, right? Our economic models at KKR were saying that GDP this year was supposed to be 2.9%.
Right. Well, Henry, I do want to talk a little bit more about the bond market. And of course, you'll be sticking with us through the next block as well. But you think about the reaction that we saw in the bond market, the violent reaction, and the Trump administration's response to that. It really acted as a braking mechanism. And you could make the case that the Trump administration, when it comes to trade policy, isn't necessarily negotiating with China here, but negotiating with bond investors, because that seems to be sort of, again, the braking mechanism on how aggressive they can be on trade policy.
I definitely agree with that viewpoint. Nobody beats the bond market. I mean, there's a term when I was coming into the business, and we saw this with Rubin and Clinton, the bond vigilantes. They won in the 90s. And if you remember, that actually created a calm. What we saw under Liz Truss in the UK and what we've seen recently is when you think about changing your cost of capital by moving too fast and the market lets you know, that's unsettling. One of the big things, I've been to Mexico, I've been to China, I've been to Europe and to the Middle East. There's a global movement, even before President Trump's announcements, to lower your cost of capital. There's a blurring of economics and national security. Let me say that again. There's a blurring of economics and national security. And what you're talking about is that blurring. Everybody wants to keep their cost of capital lower. And when it spikes, you get an immediate reaction from governments around the world. That is something that we haven't seen for the last 20 years. We all grew up in investing in a world of low growth, low inflation, tight fiscal, loose monetary. Rates were low. And every time we had a shock, what happened is the central banks and the fiscal impulse could come in. That's totally different than what you guys are reporting on and what investors are digesting. And so I think you're highlighting a really critical point.
The tariff effects and rates. Let's talk a little bit more about your business specifically. Okay. Now, there's been real excitement in a sort of a morphing of your business model in that you'll take revenues from steady businesses and invest them in very long-term steady businesses, kind of like a mini Berkshire Hathaway. How do you see it?
We have probably the largest global private equity business. We have 3 distinct funds across the Americas, Europe, and Asia. So that's our traditional, operational improvement, make those businesses better. We also have a longer-term hold strategy called strategic holdings that you reported on, and those are businesses. Just think about something like 1-800-CONTACTS or insurance broker, USI. Those are things that will hold longer, and so there's probably less operational improvement, and we've reported that now as an individual segment. So what we're trying to do at KKR, Henry Kravis and George Roberts started this business in 1976. We have a massive funnel globally. And so everything from what we did with Henry Schein in the U.S. around private equity to, you're going to see, we've been pretty busy during this volatility, so stay tuned. There's some really good operational improvement stories in our traditional private equity. And then we'll also have some things in what we call core private equity or strategic holdings that will own those for a longer term. We're doing those with partners, and it's just a different strategy, but I think it makes sense in a world where you want to just hold those assets for longer and watch them compound. I mean, compounding capital is the 8th wonder of the world, and private equity is a pretty good vehicle for doing it.
Well, let's talk about that a little bit more because, Matt brings up Berkshire Hathaway. You think about the champagne problem that Warren Buffett has is he has all this cash and nothing to spend it on. It sounds like, though, that you're not exactly running into the same problem.
Yeah, we watch Berkshire Hathaway closely. They've got a lot of cash. He's been issuing bonds in Japan. KKR has been issuing bonds in Japan. A lot of times people think about our U.S. franchise. We're probably the biggest player in Japan in private equity. There's a huge market for corporate carve-outs. We also bought a real estate manager on our balance sheet. That's helping to unlock a lot of value for those that have been around a lot. It feels a lot like the 80s and 90s in the U.S. private equity in Japan. So,
you know, one part of your business I'm really interested in is how far can this trend go? When you took that stake in Henry Schein, now we're talking about public equities, not just private equity. How many public equity stakes is KKR willing to take, especially now that we've seen a correction?
I mean, I think sometimes on private equity, let's think about a hedge fund that's moving in and out. I mean, our co-heads of global private equity, Pete Stavros and Nate Taylor, I mean, we do 5 to 10 transactions per year. But when we do it in size. I think what you saw there was we were kind of a white knight, right? There's a lot of activism that you're reporting on. Sometimes these companies want to deal with a firm like KKR that does operational improvement. By the way, we probably buy a lot of those goods in our 175 companies. So there's some things that we can bring to the table. So we are looking for control positions where we can drive the outcome. And I think you'll see us do more of that. Just to Sonali put an exclamation point on it, the last 12 months, we've been the busiest ever on public to privates in infrastructure and in private equity. And I think Henry Schein is probably a new chapter in the way we're approaching some of that.
Are you looking at investments at this point in time that might be somewhat tariff-proof or immune to some of the more challenging macro forces that we've been talking about?
Yeah, I mean, I serve as the CIO of the balance sheet, and I head our macro effort. What we're trying to do is actually take the macro out, right? A lot of times the market gets offside, either too bearish or too bullish. We want to solve for the left fat tail that things are going to be a problem. But I would just go back to what we said earlier. You know, we have KKR, the Global Institute, with General Petraeus, Ken Mellman, and me. We've been focused on this stuff with our deal team since COVID. So I don't think you're going to see a major announcement from KKR that this is a huge surprise. I mean, obviously, we're constantly navigating this environment, and it's very fluid. But a lot of our supply chains, as I mentioned earlier, have diversified. So we're trying to create resilient businesses. You have an edge in the operational improvement, and you're not being 100% beholden to one supplier. And so I think you'll see some companies that do have that. That's probably not going to be our call to arms, though.